The primary markets have remained hot in recent months with a slew of new IPOs. The latest offering on Dalal Street is from beauty and personal care e-retailer Honasa Consumer, which owns popular brands like Mamaearth, Dermaco, Dr. Sitz, and BBlunt among others. The company aims to raise 365 crore rupees from the fresh issue, while existing investors are selling 41 million shares in the offer for sale. The much-awaited IPO made headlines earlier this year due to a steep valuation ask of up to Rs 20,000 crore. Now it is on offer at a lower valuation of 10,400 crore rupees after the reduction in its size. However, analysts suggest avoiding the issue as the company's weak financial track record still fails to justify the valuation.
Investors should avoid this IPO. Despite company's consistent revenue growth, the PAT has been very inconsistent. Advertising and marketing costs are incredibly high at around 40% of the revenue, and management lacks a clear strategy for growing the company while reducing these expenses. Without patents, the company is at a risk of big competitors and new startups copying their successful products, leaving them vulnerable. Considering company's financial performance, valuations, and associated risks, the current expected market capitalization appears to be unusually elevated.
On the financial front, the revenue has been firm, rising from 460 crore rupees in FY21 to 1,493 crore rupees in FY23. However, from a profit of nearly 16 crore rupees in FY22, it posted a 143 crore rupees loss in FY23 due to writing off its acquired entity Mamaearth. In the June quarter of the current fiscal, it was again in the black with 26 crore rupees profit, but analysts suggest waiting for this trend to sustain. Analysts at MK Global further flagged the company's overwhelming dependence on the Mamaearth brand, which makes for over 80% of its revenues. As this brand gradually sees growth moderation on a high base, it is critical for Honasa to scale other brands faster to sustain its revenue momentum. Swastika Investment has also given an avoid rating to the IPO. The company's consistent return on advertising spend of 2.5% in the last few years reflects lower client retention, it says. Meanwhile, a negative 23% return on net worth is significantly lower than other FMCG peers like HUL, Emami, and Dabur, among others. Thus, weak financials and return ratios along with pricey valuations have kept analysts downbeat on the IPO. The issue was off to a slow start on Tuesday and was subscribed by 13%. Today, on November 1, the offer, subscription progress, and Q2 earnings of Ambuja Cement, Britannia, Sun Pharma, and Hero Moto will be tracked.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's about to land his dream job. Business Standard.